Gold right now is the purest fear architect in the market. The price is sitting on a knife edge at 4,566, with a daily chart screaming strong sell and a 5-hour chart screaming strong sell. Yet every headline this morning tells you to buy because bond yields are easing and Iran tension is simmering. If you chase this news, you are walking directly into the institutional liquidity trap. There is one danger zone and one hidden opportunity today. I'll show you both, and I'm giving out 3 exact entry and exit levels that you can use immediately. Stay until the end because the aggressor setup on gold has the potential to return 5 to 1 if you manage the risk properly. Write this number down. If gold breaks and closes above 4,578 on the 4-hour chart today, the entire bearish structure shifts and we step aside. That's the invalidation. The instant market verdict for this session is a fade the rip, mean reverting, trapdoor structure. We are not trend following here. We are anticipating the exhaustion of the geopolitical bid directly into the strong sell signal. The daily bias is bearish, the 5-hour momentum aligns bearish, but the news is creating a bullish noise. The highest probability path is a sharp spike into the resistance zone that fails, leaving a long wick, followed by an acceleration into the support layers. Most retail traders will interpret this morning's rise as a breakout and buy the top. We will be selling it. Write down 4578. That is your line in the sand. If that level gets violated with conviction, the trap theory is dead, and we do not fight the market. But as long as we stay below it, the danger is to the downside. Now let's go from the top timeframes down and build the full architecture of this trap. I'm looking at the weekly chart first, and this is where the fear architect reveals its intent. Gold has printed a clear lower high on the weekly, rejecting the 5,700 region a few weeks back, and now we are rolling over. The weekly moving averages are beginning to converge in a way that spells bearish continuation. The 20-week moving average is starting to curl flat around the 4,640 zone. The 60-week sits higher near 4,700, and the 200-week is way down at 4,100, acting as a long-term anchor. MACD on the weekly has crossed bearish, and the histogram is deepening in negative territory. This is not a dip buying environment on the macro scale. This is a sell-ripping structure. Drop down to the daily, and the picture sharpens. We have a strong sell signal locked in. The daily moving averages tell the story of momentum shifting. The 20-day moving average sits around 4,587 and it is sloping down hard, getting ready to cross below the 60-day moving average at 4,620. That's a death cross. In the making. The 200-day moving average is the big magnetic level, resting near 4,490. And price is caught between the converging pressure of the shorter averages above and the longer average below. When you see this configuration with a strong sell signal, it tells you that rallies are being sold. The daily MACD is deep in bearish territory, no sign of divergence yet, just clean momentum to the downside. The daily support and resistance levels are absolutely critical. On the daily, the resistance is exactly the zone you see price testing right now. 4,566 is the immediate pivot, and above that 4,578 is the structural ceiling. Support layers on the daily are 4,525, which is the first demand zone, and then 4,514, which is the March swing low. Below that, there is air down to 4,400. So these levels are not just random, they are volume-weighted and confirmed by prior structure. Now, drill into the 4-hour chart, and the trapdoor becomes crystal clear. On the 4-hour, we still have a series of lower highs and lower lows. The 4-hour 20 moving average is at 4,543, the 60 moving average at 4,575, and the 200 moving average at 4,590. Notice something here. The 4-hour 200 moving average is almost exactly aligned with the daily resistance zone. That is a brick wall. Price is currently pressing against the 4-hour 60 moving average. This is where momentum either rolls over or breaks through. The MACD on the 4-hour is still negative, but it's showing a slight tick up because of the overnight bounce on the Iran headlines. Here's what most traders miss. That tiny uptick on the 4-hour MACD is actually building a lower high momentum structure, which is a bearish continuation pattern. It's not bullish. It's loading the next leg down. Come down to the 60-minute chart, and you see the 5-hour strong sell signal has produced a tidy downward channel. The 60-minute 20-period moving average sits at 4,558, which is being tested right now as price drifts. The 60-period at 4,570 is the intraday resistance pivot. Price is meandering between the 20 and 60 on the hourly, which is typically a compression before an explosive move. The MACD on the hourly is attempting to cross above zero but failing, creating a bearish divergence against the higher price drift we saw overnight. When the news creates a price bump that momentum does not confirm, the next move is usually a violent snapback. That is the signal we are waiting for. The trigger is a failed push above 4,566, ideally a spike to 4,578 that gets rejected within an hour. Now, let's weave in the fundamental driver and the crosser set linkages, because this is where the fear architect truly earns its name. The core news from the last 24 hours is that gold prices are rising amid easing bond yields and simmering Iran tension. That sentence is a masterpiece of misdirection. Yes, nominal and real yields dipped in the US session after a softer manufacturing print, and that lowered the opportunity cost of holding gold. Yes, the Iran situation is providing a geopolitical bid, and we can see that premium also flowing into oil, with WTI crude bouncing off its daily support. But here is the cross-check that most traders ignore. If this geopolitical bid was genuinely sustainable, gold should have broken above 4,578 already, and the dollar index should be tanking. It is not. The dollar index is holding firm, and the S&P 500 is stable, which tells you that risk appetite is not collapsing. The fear bid is thin. Oil is getting a supply premium tick, but gold's reaction is fading. This divergence between gold and oil on the same geopolitical catalyst is a warning. Gold is supposed to be the fear architect, but if the broader market is not panicking, the rally is a fade. The bond yield story is more nuanced. Real yields coming down does provide a fundamental floor for gold over the medium term, but on the chart, gold is not responding proportionally. That suggests that the dominant force right now is the technical strong sell momentum and the dollar's resilience. The 1 to 2 week directional lean for gold is bearish, targeting a test of the 4,500 area and then potentially the 4,400 handle, provided the dollar index does not break its own support. The exact event that would invalidate this thesis is a daily close above 4,590, or a sudden escalation in Iran that shuts down the Strait of Hormuz and sends oil above $90. Until that happens, the trap is set. Most people will skip this next segment, but this is where money is made. Keep watching. I'm giving you 3 precise trade setups, each with exact price triggers, stops, and targets. These are designed for the current trap structure. Strategy 1, the sniper. This is the conservative play. The sniper waits for confirmation that the trap has sprung. The trigger condition is a clear rejection of the 4,566 to 4,578 zone. We need to see price push up, tap that zone, and then produce a 15-minute close below 4,558. That is the confirmation that the rug pull is in motion. Entry is a sell stop at 4,557. Or you can manually enter on a retest of 4,560 if you see a bearish engulfing candle. The stop loss goes at 4,583, just above the structural invalidation. The logic is simple. If the market takes out the rejection high, the trap failed, and we exit cleanly. Target 1 is 4,528, which gives you a 1.5 to 1 risk reward. Target 2 is 4,515. Just above the daily support, offering a 2.8 to 1 risk reward. Once target 1 is hit, move your stop to break even. This setup is voided if the price drifts sideways for more than 6 hours without a clear rejection spike. We then reassess. Strategy 2, the active trader, is the standard entry for those who want to front-run the trap without waiting for the full confirmation. The entry condition is a limit order to sell at 4,574. That's inside the resistance zone, giving you a better fill. The reasoning for the stop-loss placement is structural. We place the stop at 4,581, just above the 4-hour 200 moving average and the daily resistance ceiling. If price closes above that, the bearish structure is compromised. Target 1 is 4,535, targeting the area just above the 4-hour moving average support. Target 2 is 4,520, which is the daily support confluence. Risk-reward on target 1 is about 1 to 1.2, and target 2 gives 1 to 2. The trailing stop rule: once target 1 is reached, trail the stop by 15 points on the 15-minute chart. So if price hits 4,535, you trail the stop to your entry, then to 4,550 as it falls. This locks in profit while letting the trade run toward the daily support. Let's see how aligned we are. Type your gold range for tomorrow in the comments now, for example, 4,520 to 4,570. I'm reading them, and the most accurate range gets pinned. Strategy 3, the Aggressor, is high risk and only for those who know how to lose small and manage risk aggressively. This is a counter-trend momentum chase on the spike reversal. The entry condition: if we get a sudden wick above 4,578, specifically a 5-minute candle that spikes to, say, 4,585 and immediately rejects, you sell the close of that 5-minute candle with a market order, expecting the snapback. The stop loss is extremely tight at 4,591. That's just 6 points above the spike high. You are betting that the rejection is violent. If it's not, you are out for a tiny loss. Target 1 is 4,550. Target 2 is 4,525. The risk-reward can be over 4 to 1 if you catch the full unwind. This is not for the faint-hearted. You need to be glued to the screen and accept that you might get stopped out 2 or 3 times before it works. Only use size you can lose entirely. Before we wrap, the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news events like U.S. initial claims or sudden Iran headlines. Stops are non-negotiable. The one most critical level for the next session is 4,525. That daily support is the gateway. If we close below it on the 4-hour, the floodgates open toward 4,400. Tomorrow's focus is the U.S. jobless claims data and any further rhetoric out of Tehran. The fear architect will be testing the resolve of every dip buyer. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen and I'll walk you through the funding rate trap and the gamma levels that just triggered. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily institutional coverage across 8 assets. I'll see you in the next one, before the next explosive move.